Hi, I'm Dr. David Dobson. Welcome to Conversations. My guest today is Dhruv Baswal. Dhruv is a PhD candidate at the Smith School of Business at Queen's University. We will be discussing Dhruv's PhD research, which focuses on the effects of ESG, environmental, social, and governance disclosures on financial markets. Welcome to the show, Dhruv.
Thank you, David. Thank you for inviting me to your show. It's a great pleasure and honor to be in this show, and I'm very excited to be part of this show. Thank you.
Gaurav, to start, for anyone who might be new to this topic, could you give us a brief overview of what ESG, environmental, social, and governance disclosures entail, and why they have becoming such a prominent topic in financial markets today?
Sure. So, ESG, as you have mentioned, David, it's environmental, social, governance. So, companies, those are actually the companies that are actually working in the market, not with the objective of making profit, but also making sure that they can sustain longer term. And normally, it has been seen that companies that are more focused towards the environment, towards community, and have better governance practices are able to sustain for a longer term. And the chances of them getting into fraud or doing fraud or less because they're taking that collective approach. Also, it has to be important to understand that normally we talk about materiality when it comes to ESG, and the double materiality is this that okay, whatever the business I'm doing, that is giving profit to my shareholders, you know, but it also giving something to my stakeholders, and stakeholders are the community you're working with and the employees you're working with. So when we talk about this ESG, we talk about that ESG is the second part of it. But I argue this. I say that ESG is very much part of your business because one thing important for business is to be sustainable in a long run, and for companies to be sustainable in a long run. If they will just focus short term and only on profit, it might work well for a certain amount of time, but it may not work well in a longer horizon. So yeah, that is all about ESG. So when we talk about ESG, we talk about whether what company is doing in terms of their environmental practices, what company are doing in terms of the social practices, what companies are doing in their governance side. If the board is independent, if they take care of the employees, if they have diversity in their board, and all that factors come into being.
Great. Dharav, your PhD research examines how investors and regulators evaluate firms' ESG disclosures. What do you see the biggest gap between current ESG reporting and what's needed for informed decision making?
Sure. And this is a problem which has been talked for a quite long period of time. And the problem is this that, for decision making, we want information and we don't want noise. And with ESG, there's also a lot of noise. Like, what are the important ESG factors? Okay, how should I measure them? How much weight should I assign to them? Because eventually, if you're looking for governance, the governance could have multiple sub factors like board diversity. It could have executive compensation. It could have supply chain management, how the company is treating the suppliers, how it's tackling, let's say, modern day slavery. So all that would come. That would be the sub factors of within governance. So how you would measure them? How would you weigh them? And all so that is a big challenge, that there's lack of standardization, if I have to say, when it comes to ESG disclosure. And the second issue I feel with ESG is that there's also lack of agreement on the government side, how they want to tackle, or how they want to tackle this ESG thing, how they want to make sure that companies take ESG consideration into their businesses. So you would see in Europe where government are actually more pro on ESG factors, but then again you'll see in North America, especially down the south, that the government is not so pro on ESG factors. And in a world where we are very much connected and trading amongst our trading partners or different countries, it become a challenge.
Mhm.
So yeah, lack of standardization and lack of willingness to for governments from different countries to come on the same page.
You have highlighted the current gaps in traditional ESG reporting. Since a significant part of your research looks at social media, could you walk us through your research methodology for analyzing ESG disclosure messaging on those channels?
Sure, David. I'll talk to you about my first paper. This paper is also being published at CJAS in CJAS, so Canadian Journal of Administrative Science. And this paper was about whether firms that are doing more or posting more ESG messages on social media, or let's say they are more ESG friendly on social media, do they have a lower cost of capital? So it was tackling two things. It was tackling one, whether investor pay attention to ESG, to whether investor pay attention to social media messages, and second, whether investor pay attention to ESG specific messages. And if they do, and if they feel that those messages are important, or the companies are sharing some important news on social media which they value, then it should reflect on their cost of capital. So what I found that companies have increased their ESG messaging or ESG disclosures on social media. I was looking at the Twitter data, but that has no impact on their cost of equity. And again, the as an academic paper, so we're conducting a rigorous test. We had different measures to calculate. Okay, how would we say the company is promoting more ESG messages on social media versus companies that are posting less ESG messages on social media? And also on the other side, what are the different ways of calculating cost of equity? So this was the paper, and the outcome of the paper was that companies have increased their ESG messages or posting, or they're trying to portray an ESG friendly image on social media, but
Mm,
that is not having any impact on their cost of equity.
mm,
And normally, then we found that that's mean the investor are treating ESG messages on social media as white noise. And then we
mm,
found that this could be because that ESG, and we also found the evidence. We found that companies only post positive ESG news on social media, not the negative one. So there's a selective
mm,
disclosure.
mm,
So that also takes the credibility out of disclosure. And we also found that companies are not walking the talk. It's not that companies, for example, that are posting more environmental friendly messages on social media and portraying environmental friendly image on social media. It's not that they have been able to reduce their greenhouse gas emission in comparison to companies that are not so active on social media. So this was the paper. I want to just give the audience the outlook, the whole thing, the whole summary of the paper. In terms of methodology, so for ESG messages, I looked at companies that are in S&P TSX Composite Index, so
okay.
around 230 companies,
Mm,
and then I mapped them to their ESG profile on Twitter. Sorry, not ESG profile, their social media profile on Twitter. So and then using Twitter API, I extracted all the messages they have posted in a certain period of time I was evaluating or analyzing. So once I have their messages, then I came up with a list of keywords, which were, keywords based on ESG factors. So for example, gas emissions, emissions scope 3, governance, all those. So if those messages have these keywords, then these are the ESG messages. If those
mm,
messages don't have those keywords, then they're non-ESG messages. So
mm,
that's how I created a list of list of messages that are ESG for each
mm,
firm. Uh, and the other part was the cost of equity. Again, I used both the historical methods like CAPM
mm,
to calculate or compute firm cost of equity, and I also used forward-looking model, forward cash flow
mm,
models to compute cost of equity. So then it was a regression analysis, whether firms that are doing more ESG messaging, do they have lower cost of capital or not, or lower
mm.
cost of equity or not, to be specific.
Dhruv, one of the striking findings from your research is the challenge in identifying truly sustainable companies because ESG ratings from different providers often don't align. From
That's
your
true.
perspective, what are the major consequences of this lack of correlation among ESG ratings, particularly for investors aiming for sustainable portfolio and for companies genuinely committed to improving their ESG footprint?
I'll start with the layman example. So
Okay.
take into consideration the credit score. So
Okay.
we have Equifax, and we
Yeah.
have another which is TransUnion
Mhm.
credit rating agency. So let's say we have credit score, my credit score by these
Mhm.
two different rating agencies, these two credit score agencies, and let's say one rank me high and one rank me lower.
Mhm.
If I go to a bank to get a loan, what would be bank's impression? Whether should they go with Equifax or with the
Mhm.
other credit rating agency score?
Mhm.
So when there is lack of consistency, it always impact our decisions.
Yeah.
It's always the case. When there's lack of consistency, there's lack of trust in the market. When there's lack
Mhm.
of trust in the market, the flow of capital would not happen as efficiently as it would have happened if the trust had been more in the market. So this is the same, and the ESG rating. In ESG also we have the same challenge. So we have a lot of rating agencies that provide ESG ratings. Now these ESG ratings don't correlate well. What does that mean? For example, one company, and it's a hypothetical example, one company can rate Tesla very highly on
Mm-hmm.
ESG,
Mm,
and other company may rate Tesla moderately.
mm,
And you would say, okay, ESG, in a very simple world, let's say Tesla, because electric car company, it should be has a good ESG ranking. It should
mm,
be if you're putting more weight on environment, right?
mm,
Because that's they are adding less carbon emissions
mm,
to the atmosphere. But if you're paying more weight on the governance side, maybe it would have low ESG ranking.
mm,
So that's the challenge. So the challenge
okay.
is there is lack of consistency in ESG rankings. As a result, these
Mm,
ratings don't correlate well. And when the
mm,
rating don't correlate well, investors they get suspicious. They are on the back foot. Should I invest in this company? Should I not invest in this company?
mm,
I'm not very sure if this company is the right invest. I really want to do good. I want to go my capital to companies that just don't think about profit, but they also think about community. Uh, but I don't know if this is the right company because I have two contradictory data in front of me.
mm,
So what this does that it actually this lack of inconsistency in a way is a challenge because it doesn't let an efficient allocation of capital happen. So, and to give you an example, so that is one issue. The second issue is that even when the capital allocation is happening, it may not be right, which is actually seen as not efficient allocation of capital. So, for example, I might be doing a lot of good work, but I don't have a good MSCI rating. And if you, as an investor, uh, are basing your decision on MSCI rating, you might
mm,
not put money in the company I'm operating, even though I'm really doing a lot of work on the environmental side.
mm,
So that's a challenge. I mean, because of lack of consistency, there's less trust in, or there's
mm,
less confidence in the market about what are the good companies versus bad
mm,
companies when it comes to
mm,
ESG, and that impact the efficient allocation or efficient flow of capital towards
yeah.
ESG initiatives.
Go back to those ESG rating divergence. Given
Yeah.
those significant consequences of ESG rating divergence and recognizing that much research identifies the problem without offering concrete solutions, where do you believe are the most promising avenues for developing effective strategies to help investors and regulators better identify truly sustainable firms?
It's still growing space, so there's no well-defined answer or path. It's not like the accounting. For accounting, we have those
Yeah.
lot of studies. We have a
Mm,
set standards that these
mm,
things you have to do, and
mm,
these things will tell you whether the company is good or bad. You
mm,
can misreport, but at least you know the factors. For example, for leverage, maybe I wanted to look at the leverage ratio of a
mm,
company. Is it good in comparison to its competitor? If the company is highly leveraged, that's mean, maybe I don't want to invest in this company because in bad time they might go bankrupt. They might not be able to produce
mm,
enough money to
mm,
pay the interest, and it might go bankrupt. So we have a set criteria or parameters when it comes to accounting.
mm,
In ESG, we don't have that.
mm,
Uh, so to your question, I would say that first thing, don't rely on one ESG ratings because these ESG ratings don't correlate well. So if
mm,
you would just rely on one ESG rating, then you would not make a good decision about your investment going to right companies when it
mm,
comes to their ESG work. So have a more holistic approach.
mm,
Look at multiple ratings to
mm,
come up with a better decision. Now you can say I can use the average. I have the ratings. I take the average, and then I can list the companies on the basis of their average, and
yeah.
whatever the companies that are high on average are the good
Yeah.
ESG scores. But you have to think that these ESG ratings they don't correlate well because they have some right information. They would have,
Mm,
but they
mm,
also have noise, right?
mm,
And because of this noise is random, and
mm,
that's actually
mm,
is where the correlation is not that high because of this noise.
mm,
So the average won't help you to reduce the noise.
mm. Gaurav, based on your work, what are the primary factors contributing to this lack of convergence among ESG rating providers? And what do you see as a practical first step toward bridging that gap?
Sure, David. So the lack of consistency is because of three reasons. First, there's a lack of agreement about what are the important factors. Secondly, so how would you measure them?
Mm,
Again, there's no standardization. How would you measure these factors? And data is also an issue. Third, how would you weigh them? And to give you an example, for example, we can take example of environmental rating. So environmental could be greenhouse gas emission. It could be, it could be also the natural destruction you're causing. Let's say, the operation impacting the wildlife, for example. Okay. And whether you're also polluting the natural lakes or natural resources. So how you're impacting the environment by emitting more greenhouse gas, how you're impacting the wildlife, how you're impacting the environment. Okay. So companies could vary about what factors they would take into consideration. They could vary about how would they measure them. And they could also vary on how would they weight them to come up with environmental rating.
mm,
So that's why, so that's why the ratings don't correlate well, because
mm,
first of all, there's no standardization on what factor you should consider. There's no standardization how you should weigh them. There's no standardization how you would measure them. And to your second question, then okay, this is the issue we have. How we should tackle this issue? This is still a developing space, I think. But the first thing we could do is not to rely on just one rating. So,
So, given this, the ESG rating divergence, you have developed a multiple discriminant model that quite accurately predict the firm's ESG performance. Could you tell us a bit more about how this model works and what makes it so effective?
uh, you know, uh, uh, so as we were discussing that these ESG ratings don't correlate well, so that's mean, but we would all agree that this all these ESG ratings should have some information. They don't correlate well because of the noise component. So if we can have an approach where we are not using one rating, we are using multiple ratings,
Mhm,
but we can reduce the noise component. So a score based on multiple ratings and reducing the noise component is what multiple discrete analysis does.
mm,
You can take the average, but the
mm,
average is not a noise reduction technique. It would
mm,
average the noise as well.
yeah.
So yeah, this is the difference, and that's what I propose that we should not still rely with one rating. We should rely with multiple rating,
Mm,
but we should use it in a framework that's not only using multiple ratings, but also using in such a fashion that it can reduce the noise in these ratings.
mm,
So you would have much more accurate picture about firm's ESG performance.
mm. Now, shifting to the practical side of your research, considering your research helps both investors and regulators, what practical change you believe would really improve the landscape of ESG evaluation and disclosure in the near future?
Uh, well, one thing I think Canada government also started working on it. Then they put a pause on it. But the one thing regulators can do uh, is to make sustainable reporting mandatory.
Okay.
So right now, sustainable reporting is not mandatory,
Mm,
and as a result, we don't have the full picture about what firms are
mm,
doing. It comes when it comes to sustainability. They
mm,
can cherry pick what they want to show.
mm,
Right? So if they at least would make the sustainable reporting mandatory, and they would
mm,
also specify that okay, these are the factors which you have to disclose,
yeah.
we still would have a problem, how they're measuring it, whether
Mm,
they are, if there's no financial repercussion, then
mm,
companies may misreport it. That would be there. I
mm,
think that would only go gradually. But as a first step, at least they would be in the market, the market would have a better picture what the firms are doing.
mm,
And the pitch and the information is also comparable because the regulators have defined, okay, these are the things you have to report. So you can
mm,
actually also compare.
mm,
Whereas right now, firms can cherry pick what they are doing. For
mm,
example, Tesla, they
mm,
might put a lot of importance on what they're doing environmentally, put very less
mm,
importance on what they're doing on the governance side. And
mm,
let's say GM, they might not put that much importance what they're doing environmentally, but they put
mm,
a lot of importance on what they're doing on the governance side. Now, these
mm,
reports are not comparable if I want to invest in a car company.
yeah.
So at least the reports would become more comparable with the
Mm,
mandatory reporting.
mm. That's a great idea for moving forward with ESG evaluation. As we wrap up, Dhruv, what's next for you, both with your research and perhaps beyond?
So this is so I'm pretty much towards the end of my fourth year, and I'll be starting my fifth year. So from my personal objective side, I want to graduate this year, and I'm also plan to be the job market. On my research side, I'm working on the paper. So my first paper has got published, and most of the at least here we have to work on three papers, research papers. So my first paper has got published. My second paper, which uses multiple discrete analysis to come up with the ESG score, which
Mm,
is a better evaluation score
mm,
than using the average or just relying on one rating. I have presented in a few conferences, and I hope, like I can get it published by next year. But at least I'll start submitting it to different I'll start submitting it for publications in a week or 2 weeks from now. So those are my goals right now. I mean, very practical goals from a student perspective,
yeah,
getting something published and getting a job.
yeah, for sure. Dharav, thank you so much for your time and sharing your interesting research. We wish you all the best as you finalize your PhD and embarking on your next steps.
Thank you, David, and thank you for giving me this opportunity to share my research, to share my passion with your audience. This topic is very close to me, and I'm glad that I was able to share what I'm doing with the larger research community. So thank you for giving me this opportunity. Thanks a lot, David.